Ratios, ratios. I mean, who cares about the US dollar these days? Maybe gold is more important, or maybe the gold to silver ratio is important, or maybe gold priced in oil, so the gold to oil ratio is more important. So, I mean, let's talk about those ratios, and in specific about analyzing cycles in ratios. That's the topic for today, so stay tuned.
From the mind of Lars von Tienen, the most advanced cycle analysis, hot off the press.
Yeah, thanks for joining another episode of Cycles TV. We are here to analyze cycles and to discuss the purpose of time-based cycle analysis on financial assets. That's why we're here. Thanks for being with me today. So, today I want to also introduce a new feature we have implemented to make it easy for you to analyze ratios with our cycle analyzer. So that feature is one topic I want to discuss with you and showcase how this could be used from your perspective. And second, these days there's an ongoing discussion in who uses the US dollar as global currency to value assets. That's not the discussion we will have today. Yeah, there are other experts that's above my pay grade to have that discussion or even a view on that topic. But the analysis of assets not valued in a special currency, valued against a different asset, so valued against gold, valued against silver, and the ratio of those assets is, on the one hand, that's interesting per se, to see what the valuation between those different assets is. But, and we are here to analyze if there is a cyclic pattern in those ratios. So is there a rhythm within the asset valuation between gold and silver or the dough and gold? So that's why we are here. So the beauty is once we have those ratios at our hands, we can quickly run cycle analysis on those assets to see if there is a dominant cycle in those ratios. That's the topic for today. So let's get started. Let's start with the obvious. So let's have a perspective on the US Dow Jones indice, but instead of measuring it in US dollars, we will look at the Dow Jones measured in gold, right? So let's bring in our cycle screen and let me show you how that works. So first we will open the basic Dow Jones indice as we would do against the US dollar. So that's the basic screen you are familiar with as we analyze those cycles here. So, but instead of analyzing that raw price, now I want to show you how to bring in the ratio. And therefore we have now implemented a new feature which can be activated by going to indicators, and there's a new selection available which is called Build Ratio Series, as shown on the screen. So with that button, a new window opens which allows you to select whatever asset to use for building that ratio. So you're not limited to any special ratio. So you can now choose, for example, valuing the Dow Jones in gold. So I'm selecting now the gold futures price to create the Dow to gold ratio, right? So let's just put in that series as it is shown up here. So the gold futures daily. Let's press OK, and here we are. So now we have a complete different perspective on the US markets. So here we see now the Dow Jones index priced in terms of gold. And that's a quite different perspective. On the fly, we have created the time cycle analysis right at the bottom. So this is, with a blink of an eye, you will find the dominant cycles now in this ratio. So you might have seen how this has switched, and we can now perform a dynamic time cycle analysis in the ratio, so Dow to gold ratio. We identify 3 possible cycles which qualify to be dominant and stable. These are our criteria. So to answer that first question, yes, there is a rhythm in the Dow to gold ratio. So that's the first interesting topic as an analyst interested in time cycles. So there seems to be a cyclic rhythm in the Dow priced in gold series. So let's have a view on that here. So the Dow to gold price is around 10. I mean, there's an historical analysis when gold is overpriced or the stock market is overpriced. There is also an historical discussion about what is the threshold, but I will not go down that discussion with you today. So I think you can do this on your own, or you know about it. So I will not touch on the absolute raw value and the discussion of the absolute raw value. Let's now have a look at the time-based cycles. So here is one, so the shortest, it's the shortest cycle with 123 days, which is the rhythm which is shown here, which forms a nice cyclic rhythm, which is currently going into a low Dow priced in gold. We can also analyze the 176 cycle, which is also shaping a nice rhythm here, so not completely in sync with those 123, so we can overlay them. They both formed very nice topping areas around here and here. So this is where I think you can identify those tops here. So this bottom is not a perfect alignment, because we have 2 bottoms forming up here using those 2 cycles, while in the past we had 1, 2, 3 periods in time where both cycles synced. So they now go a little bit out of sync, which is not a perfect situation because those form a different situation here looking into the future. But that's just those 2 cycles. And there's a 3rd cycle here, which is also dominant, so it should not be overlooked, which is here a different perspective which needs to be carefully seen. But those 3 cycles could be taken into account. I mean, I will not do a full analysis what this means. I would leave this up to you. I would just want to quickly showcase what is now possible. So based on those key cycles here, it was quite easy to spot those 3 points in time where those cycles synchronized their topping and their bottoming state, which is not what is showing up here. So at this point in time, it's not as easy to read the future projection out of the dominant time cycles for the Dow to gold ratio. But it's just one perspective. And as you know, with those ratios, I mean, the one asset can go down and the other asset can go up, or the other way around. So you always have 2 options how the ratio can change. So that's one possible perspective. So what about the gold to oil ratio? A second very popular measure or economic indicator to judge the relationship between the gold price and the oil price. And those 2 assets also mainly have a kind of balance or balanced perspective. And if the balance goes out of sync, there's a reversion to the mean between those assets. Yeah, and let's see if there's also cyclic rhythm. So now we utilize our platform. Let's open now gold as primary vehicle first, and then let's create the ratio to oil. So let's do that again. So we clean up the mess here, and we start now with opening gold first, because this is our first asset here. So here we open the gold price daily, and now same procedure. We want to build the gold to oil ratio. Therefore, we activate the build ratio services indicator again. And now we load the oil futures, which we want to calculate against the gold price. Press OK. And here we go. And now we have the gold to oil ratio, which is, I mean, that's, you see that spike into the sky. I mean, that's quite out of any sense right now. I mean, oil is just going down and gold is exploding, so the ratio is shooting to the moon. But that's how you look at ratios. And the beauty of those ratios is now, as said, those ratios are often in kind of balance, or they have the reversion to the mean characteristics, and that comes in cycles. So here we have a quite obvious picture. There's one key cycle which should be used, the 121, 157 maybe, so let's discuss those two here, but that's the first obvious one with double of the strength, so of the other one. So that's quite the most dominant one, and that's why I would maybe first ignore the 157. Yeah, so both have a high stability, but the cycle with a length of 121 has double the strength, so it has double influence on the price change per day than the other cycle. So therefore, that's the most dominant one with impacting price change per day. So that's why we go with this cycle here. Just for further explanation, you can create the info box and open the stability visualization on that cycle also, so you can compare how the real cyclic movement of the gold to oil ratio performs against the theoretical time cycle, which is the red one here. And we have a beautiful, beautiful alignment of the real action within the ratio and the theoretical cycle. What you need to have in mind that the cyclic perspective is always a detrended perspective. Yeah, and that's why, to explain what that means, is going back to the full screen here, we have a kind of uptrend, yeah, in that data series, which is taken out of consideration for the pure cycle analysis. So we are analyzing the cyclic behavior around the trend. So that's why the cycle is just shown as a cycle, as a detrended version. But if we bring this back onto the chart, we always should have in mind what the underlying trend is. Yeah, so that's why I'm just putting that in. So, and the cycle now goes around that trend. So we have, yeah, that kind of cyclic movement. No, it's not beautiful. So let me try to plot that here. So we have the cycle around the trend looks like this here. So, and that's the kind of trend here. So now you see the cycle and the trend. And what we just analyzed here is the cycle down below. So we are in a strong uptrend. And now that cycle is coming to an end. At least the time cycle projection is coming to an end with this sharp up move here. So I think that's an interesting and quite clear analysis related to the perspective of the gold to oil ratio, we can now also add our other prominent cyclic-based indicators here. So we can now activate the cyclic RSI, which gives you another indication here where we are in that ratio. Yeah, so we are at this exhaustion state here, but it indicates here that we could be close to that ratio having a turnaround. So either oil need to go up or gold need to go down, or both, to let the ratio come down. And you now can prepare your possible investment or trading strategies based on the ratio. I mean, that offers you more complex trading strategies or even option strategies, maybe going short the gold and long oil, or a combination of both. So you're a little bit secure around that. But that's, again, here we don't do any trading advice, but the ratio allows you to have a different perspective now and offers you different trading strategies and portfolio strategies, how you want to judge such an cyclic projection on that ratio, which here, and that's the difference to the Dow to gold ratio, where I told you the future projection is not as clear because we had 3 possible cycles and they are not synchronizing in the current future, which makes the projection quite hard. But here in that sense, so the gold to oil ratio, we have one clear dominant cycle, not 3, one very clear cycle, which indicates the current situation, also now in alignment with the main ratio price situation here. So that's a more beautiful picture for deriving some consequences here in the gold to oil ratio. But let's continue that story now. So we had gold to oil ratio. We had Dow to gold ratio. What about gold to silver? What about the gold to silver ratio? I mean, those two assets should also have a kind of balance between themselves. Yeah. So if the ratio goes out of sync, it would make sense you expect also a reversal to the mean. And maybe there's a rhythmic behavior in that ratio. So let's have a look at the gold to silver ratio. As simple as that. Let's open first a new chart. I mean, we have it already here, so let's chart gold first. Here we have gold. Let's clear up the indicators. Here we have gold. Now we want to create the ratio to silver. So same procedure. Let's activate the ratio series. Now we choose silver. Yeah. So the silver futures where the ratio should be built. And here we go. Now we have the gold to silver ratio as indicated here right at our screen. And not only that, we also have the rhythm and the cyclic behavior of that ratio. So here we have also a kind of clear situation which cycle to pick. And I hope if you follow our episodes and know how to read our cycle scanner, it should be quite clear. So I will guide you here. So the cycle with a length of 178 days in that case is the most important because it is the second highest stability. Yeah, so it has a very low variation over time in regards to length and phase. So it's a very stable cycle over time. And second, it even has the highest strength score, as you can see here, 2.43. And it's not the highest, but one of the highest, at least, again, the double strength than the longer cycle with 343 days. So I would rate same stability scoring and very high stability above 0.7, 0.8. And here the strength is, again, we have double strength with 178. So that's why that should be the preferred most dominant cycle to pick. And after that, we can then maybe discuss the shorter cycles here. But that's the first cycle to go. And I hope now you see how quickly you can browse different ratios, because it makes it very, very easy now to pick whatever ratio you're interested in. You instantly see the dominant cycles in that ratio. We have a very objective way of picking the dominant cycles, which I just do quickly in this episode here, and then you have it overlaid on the chart right here. So here, again, let's first roll back and see the stability in action and the strength in action. So let's roll in our stability scoring here, and again, you see a very, very nice and high correlation between the blue, so the real cyclic rhythm of the gold to silver ratio, and the theoretical static cycle with a length of 178 days. So the lows and the tops have a very low shift between the theoretical peak and the real peak, or the theoretical bottom and the real bottom, and here the real top and the theoretical top from a time perspective are almost perfectly in sync over the past 1, 2, 3, 4 full repetitions. I mean, we could even go longer into the past, but that's what I said. Here in that case, we don't have a big trend, so as with the other ratios. So it is already detrended. And you see that cycle now in terms of time now going around that perspective here. So that's the cycle in action on that data series. But I mean, that's just the visual explanation of what we are here looking at. Oh, no, I want to have that cycle. Oops. So here we are back. Sorry, here we are back to gold. I disabled the ratio. I was too quick, so let's bring in the ratio again. Gold to silver. So here we are. Here's the cycle. This is what we wanted to look at. So we have a very interesting swing, which seems to be completed now from around April, May. So in that area where that top started. So gold topped compared to silver. So now we have the downswing here, or where silver outperformed gold. Let's call it that way. So which from a timing perspective now maybe should have come to an end. So the outperformance of silver versus gold could have ended just looking at that cycle here. So that's how to read that ratio. So from now on into maybe early 2026, gold will start to outperform silver again. That's what the cycle tells us within that ratio, which again allows us for different decision making in our portfolio or trade decisions, or even now adding different technical indicators to that ratio, so we can monitor when we get the trigger based on our cyclic optimized technical indicators here. So that's how to read the gold to silver ratio. I think also clear, actionable insights. Finally, one of my favorite ratios is the natural gas to gold ratio. I used this several times in previous analysis, and I'm following that ratio very often. So let me bring in that ratio and show you how quick now we are able to pull up those ratios, right? Same procedure as always. So cleaning up the chart. That's it. So in that case, we start first with loading natural gas as the main series here. So that's the natural gas, US natural gas futures. And now we want to chart them as a ratio to gold. So same procedure. Let's bring in the ratios. Let's chart natural gas against gold. And here we have the ratio of natural gas versus gold. So here there's a long-term cycle and a shorter-term cycle, which we need to be careful with this one here based on the ranking, because it's a kind of flattish plateau here. So need to be careful even if it is stable, but that long cycle maybe just has 2, maybe 3 repetitions. That would explain the stability. You see, it's just maybe 1.5 iterations. That's the highest stability, but the perspective here in our spectrum is not as I would like it to be. You see, it's not the number 1 ranking. So I would like some of those shorter term cycles here, 148, which seems to be qualify stable. It has a ranking which seems to be, that's not easy. So we have different options to choose here. So, but let's get back to the main story here. So here we have the rhythm on natural gas to gold ratio, which, by the way, if you have a look at that procedure, it follows almost also a yearly rhythm. So we can see also some kind of seasonality in that rhythm, where we have kind of bottoming here in March, April, then an up run, and then again down into the October period. So again here, a bottom in March, April, and an up run in the bottoming in October period. So I saw that pattern, and that's kind of seasonality in that series, by the way. So it's kind of seasonality in natural gas, having this spike into summer, March, and then October, and to end here. Here we have it again. And now, I mean, nobody knows if history repeats exactly as it did, but at least the cycle showing us the October into the year-end rally, maybe on the natural gas to gold ratio. That's it for today. That's first a new feature. You can now analyze ratios between assets with a blink of an eye, which really improves our toolbox as an analyst of financial markets or financial assets, because it offers a quite different perspective instead of just looking at priced in US dollars. So the currencies or the volatility of currencies is taken out of the equation by using that, which really pulls up other cycles which are not influenced within a specific currency. So that's quite interesting, and I think it's also quite important to have the knowledge on first how to analyze ratios, and second, now how easy we have made it for all of you to perform that kind of analysis. That's it. I hope you enjoyed that session. Let me cross-check your questions. So we're live again. So I will have a view in the chat area. Okay. Okay, so Alirizera, what does the curve in case of gold and silver means when we have a top or vice versa? What does it exactly mean? So, I cannot everything on ratios, but it shows you the relationship between gold and silver. So how those two assets perform over time in price of their valuations against each other. So, for example, a top in the gold of silver ratio means that gold is overpriced compared to silver based on their historical perspective. And the other way around, if we have a bottom which looks like that silver is higher priced than gold compared to their average balance in the past. So you can see that and if that ratio goes down, then silver outperforms gold. And if that ratio goes up, then gold outperforms silver. So this is how to read those curves or those ratios between gold and silver. So that's the basic usage of those ratios. And we just try to identify the points in time when one asset maybe outperforms the other, or when the outperformance might come to an end from one asset or the other. So it cannot be used to indicate tops or bottoms in one asset priced in US dollars or currency or whatever. It just tells you when there is an expected change in trend that one asset outperformed the other asset. So that's where these ratios in cycles help. As well, chaser trading. Sure, go back to your charting platform and be happy. So, that's not why we are here. I'm not here to explain the RSI. So, happy use of whatever technical indicator, you're good to go. That's not the purpose here. So, hope you get a little bit kidding. But one honest answer now. And maybe you've seen that. We are not using the basic RSI here if I'm showing that. So, using a basic RSI on everything is useless. Technical indicators are just something of the past that will not help you. So you need to be aware of how to fine-tune technical indicators and the RSI based on the dominant cycle. And that's what we're doing here. So if I have shown you a technical indicator, this is not the basic RSI. By all means, it's not. As I said, go back to your charting platform and be happy. What we are doing here, we are optimizing, for example, the RSI based on the dominant cycle we have selected. So this will be used as a parameter to calculate the RSI and even further optimizations, which makes that indicator even more important. So we are setting the frame with time-based cycles for technical indicators. So which then allows a technical indicator like the RSI to really spot tops and bottoms much more precise than a standard technical indicator. That's the difference between using standard indicators and cyclic tuned technical indicators, and that's what we're doing here. Dan, thanks for also following up on that. So I think well phrased, Dan. Thank you. So you're in that discussion, I think, Dan, and Swell Chaser Trading. Yes, we're looking for points in time when the time cycle aligns with the price information given from a technical indicator. So I think maybe that's as a final note. Often, let me try to identify or explain it in that way. So it's a very interesting discussion you are currently doing here, and it's an important discussion. So don't get me wrong. So let's have some serious talk on that. With the purpose of dynamic time cycles, we are just looking at time, not at price. We're just using price to isolate time-based cycles. And then we are looking for the points in time when those cycles roll over to identify those points in time when maybe the next change in trend in price could happen. But no one can trade time. So it's just a projection. It's a window of opportunity based on a recurring time-based pattern. So that's the cycle analysis. So often we need to have a confirmation that our time-based projection or window of opportunity maybe is in alignment with price action. Because if it's not, it does not always mean that the time cycle will predict what happens to price. So we need to wait for a confirmation of price to really act in the window of opportunity we isolated with cycles. And to identify those confirmation in a window of opportunity, that's why we look at that technical indicator tuned to the dominant rhythm. If we see the price confirmation, which can be seen by using a technical indicator tuned to that cyclic length, if price confirms a reversal within our expected point in time in the future. So that's how we combine time-based cycle analysis with technical analysis, and RSI is just one example which can be used for that. Because it's not always the case that we have a time cycle window of opportunity and the technical condition of price completely disagrees which means the time-based projection is invalidated because price action is not confirming that. And this is then where technical indicators help to confirm, to see a possible oversold or overbought market. And Polaris, maybe to end on that note, that's exactly a very, very promising area of research. So Elliott wave analysis, which are fractals or patterns based in price action and price targets and price ranges, which they happen in 5-wave ups or ABC corrections, which help to spot price patterns, waves, Elliott waves, and then see if those Elliott waves, 3s and 5s, or even a possible 4, align with time cycle projected bottoms or tops. Absolutely agree, Polaris. That's a very important area. And if you are able to combine, for example, your individual Elliott wave pattern price analysis, you have a very good idea of what you expect in terms of price action. And if you have also using the time cycle analysis, you have a very good idea of what could happen in terms of time window of opportunities. And if your expected price pattern in terms of Elliott waves approaches an important possible ending wave in a time-based cycle window, then we have confirmation of time-based analysis and Elliott wave price patterns. So that's even more advanced than using simple technical indicators. So I think I would leave it with that. So we have had a combined discussion now on a little bit on ratios. So I think you got the picture. Ratios on their own are a specific knowledge area in economic financial series. And how to judge those ratios is a special topic on its own. But now we are able, in a very simple and fast way, to utilize this with time-based cycle analysis. That's it for today. Thanks for being here. Jux, I think that's why I try to be live, and this is why I like your attendance. Because I want to understand your questions, and I'm really here to explain what we're doing. So your questions really help, not only me, also the community, to get the questions which are burning in your head on the table to have a live discussion. So I would engage you to really join those live sessions, because you have the opportunity to raise those questions. I am here live in person. Yes, it's me. It's not an AI avatar. It's real language, real knowledge, a real person sitting here trying to help ourselves to understand the world of cycles. That's the perspective. I don't have all knowledge, but together we can learn and we will get better moving forward. So, thank you for today. Please join us next week at the Foundation, same time, same place. Have a safe week. Stay safe.